We're looking at a stock that just surged 28% in 2 weeks, which, normally dictates a pretty clear narrative.
Right. Normally, you'd think it's a massive breakout.
Exactly. You'd think the market is celebrating and the bulls are just completely in charge. But when you actually step back and look at the broader landscape for Meta Platforms, ticker symbol Meta, that clear picture just completely shatters.
It really does. It's incredibly polarized right now.
Yeah. And today is April 2026, and we are staring down what might be one of the most confusing setups on the board.
Oh, absolutely.
So the burning question for you guys today is this. Is this tech giant currently a brilliant, undervalued buy, or is it just a massive, perfectly disguised trap for retail traders?
And that tension is everywhere in the data. You've got this huge divergence between the underlying financials and the technical price action. It's essentially a battleground between institutional asset managers and everyday retail investors.
Which is exactly what we're going to tear into today. We've got a giant stack of sources for this deep dive. We're talking Meta's fiscal 2025 financial reports, some very telling technical charts, all the latest analyst ratings, and this is huge breaking news regarding a major workforce reduction.
Yeah, the layoff news really shifts the context of everything else.
It really does. So our mission is to cut through all the noise, decode these conflicting bullish and bearish signals, and figure out what is actually happening with Meta's stock.
But before we get into the weeds, we should probably throw out our usual disclaimer.
Good call. Just a quick reminder that this deep dive is purely an educational exploration of the data. We're analyzing the market, but absolutely nothing we discuss here is financial advice.
Right. Do your own research, always.
Exactly. And hey, if you're watching this on YouTube, take a quick second to like the video, subscribe to our channel, and make sure you leave a comment. We want your feedback on where you think this stock is actually heading.
All right, so let's set the baseline here. As of today, Meta is trading at $681.32.
Okay.
And that 28% jump you mentioned earlier, that's really just a bounce off a pretty violent swing low we saw back in March.
Right. It dropped all the way down to $525.
Exactly. So even with this really aggressive 2-week rally, the stock is still sitting well below its 52-week high, which was $796.25.
And if you look at the 52-week low, that's way down at $479.80.
Right.
So this stock has just been whipping around in this massive $300 range.
It's been incredibly volatile.
Yeah, but today it's trading in this razor-thin daily range, just between $675.13 and $691.52.
Which tells you the market is basically holding its breath right at this level.
Exactly. It feels like everyone is just waiting to see which way the wind blows.
Well, they're waiting because the company's engine room, like the actual financials, is sending some incredibly mixed signals.
Okay, let's unpack this. Start with the good news.
The good news is that their fiscal 2025 performance was just staggering. The scale is hard to overstate. Meta brought in $200.97 billion in annual revenue.
Wow, over $200 billion.
Yeah. And their net income, the actual bottom line profit, hit $60.6 billion.
Wait, so that means
That's roughly a 30.08% profit margin.
keeping a 30% profit margin at a $200 billion revenue scale is just insane. You really don't see margins like that outside of, heavily entrenched monopolies.
You really don't. And they absolutely crushed the fourth quarter of 2025, too. They posted an EPS of $8.88, which easily beat the $8.19 estimate.
So the core business is just a cash machine right now.
It's operating at peak efficiency. I mean, the family of apps, Facebook, Instagram, WhatsApp, they generated $115.8 billion in cash from operations for all of 2025.
That's massive.
It is. They're maintaining a positive free cash flow of around $10 billion every single quarter.
So they have an advertising delivery mechanism that is just functioning flawlessly.
Flawlessly. But, and this is the huge catch, you hear all those numbers and you picture this invincible fortress-like balance sheet, right?
Yeah, you'd think they were just sitting on mountains of cash.
Well, they were. But by late 2025, Meta's actual cash reserves dropped to about $44 billion.
Wait, really? Only $44 billion?
Yeah, they are burning through cash almost as fast as they generate it.
Okay, let's unpack this because that sounds completely contradictory. It's like earning a massive record-breaking salary, but instantly draining your savings account to fund a never-ending home renovation.
That is a perfect analogy. And in Meta's case, that renovation is their aggressive AI infrastructure spending.
Right, so we have to ask, is this level of cash burn actually sustainable, or are they mortgaging their present stability for this really uncertain future?
That's the core debate. The capital allocation strategy has pivoted so hard. To stay dominant in generative AI, they're spending at a scale that fundamentally alters their balance sheet.
And let's be clear about what this spending looks like. They aren't just, upgrading software or renting a few more cloud servers.
No, not at all.
They're buying tens of thousands of NVIDIA GPUs. They're securing massive amounts of power directly from the grid. They're building these custom liquid-cooled data centers from the ground up.
Exactly. It's heavy physical infrastructure. It's more like a heavy industrial manufacturer now rather than a lean software company.
Which totally shifts how you have to evaluate them.
Right, because the market is used to software companies having high operating expenses but low capital expenditures. When Meta starts draining tens of billions in CapEx, the market gets spooked.
So the question is, are everyday investors actually realizing this massive cash burn is happening, or are they just opening their brokerage app and chasing the recent green momentum?
I think a lot of them are just chasing the momentum, and you can see this tension manifesting directly on the technical charts right now.
Yeah, let's talk about the charts. It's basically a battlefield between retail traders and institutional investors, isn't it?
100%. If you look at the short-term indicators, they are heavily skewed bullish.
Right, the 14-day RSI is sitting up around 73.59.
Yeah, which puts it firmly in overbought, strong buy territory. And the MACD is sitting at a bullish 9.79.
And the price recently cleared the 50-day moving average, right?
It did. The 50-day SMA is at $629.85, and the price confidently broke above that. So if you're a retail momentum trader just looking at a daily chart, all the lights look green.
And here's where it gets really interesting. They are slamming right into a massive macro ceiling.
The ultimate ceiling.
Because today's price is hovering right around $681, which is exactly where the 200-day simple moving average sits. I think the sources said it's precisely at $681.26.
Yes. They are actively testing that 200-day SMA right now. And you have to remember, they are testing this resistance within the context of a macro channel down pattern.
A channel that's been in place for a while.
Since August 2025, it's been consistently printing lower highs and lower lows for months.
Okay, so let's talk about the trap debate. Who is actually buying and who is selling right at this line?
According to the data on TradingView, retail sentiment is currently marked as extremely bullish.
Of course it is. They see the stock jump 28% from March and they pile in.
Exactly. Everyday investors are aggressively hitting the buy button. But the tape shows something else. Heavy institutional absorptions happening at the exact same time.
So the smart money is stepping in. Walk us through how that works, because institutions don't just dump everything at market price, right?
Right, they can't. If a fund managing billions tries to exit a position that size all at once, the price would crash, and they'd lose a fortune to slippage.
So they need buyers.
They desperately need deep liquidity. So when retail traders stampede in on short-term momentum, the algorithms use that buying pressure. They park massive limit sell orders right at major resistance lines.
Like the 200-day SMA we're sitting at right now.
Exactly. They quietly offload their shares into the retail frenzy without dropping the price.
Wow. So if retail traders are blindly buying because of the recent jump, and the big players are quietly taking profits and selling at this exact resistance level, are everyday investors just walking straight into a volatility trap?
It certainly looks like it. They are essentially being handed the bags at the absolute peak of this short-term rally.
That's terrifying. So what happens if the institutions finish unloading and that retail buying power dries up?
Then the trap springs. If it fails to break decisively above 681 and rejects, the immediate downside support is at $634.
And what happens if that 634 support level breaks?
If that breaks, the chart shows very little structural support until you fall all the way back down to that March swing low of $525.
Yikes. That is an air pocket of over $100.
It is a brutal risk-to-reward ratio for anyone going long today based just on the last 2 weeks.
But Wall Street can't be completely bearish on this, right? Because when you look at the analyst consensus, it paints a totally different picture.
Yeah, the institutional analyst side is actually overwhelmingly bullish. Out of 67 analysts covering Meta, the consensus is still a buy or strong buy.
That's a lot of analysts agreeing on a buy. What's the target?
The median price target is sitting at $840.07, and the highest target is way up at $1,117.
Okay, so they're projecting massive upsides from where we are right now.
Yeah.
But how are they justifying an $840 target when we just talked about them draining cash to buy servers? What are the actual catalysts here?
Well, the bulls are looking at growth and undervaluation. Meta is seen as the undisputed leader in consumer AI glasses right now.
Right, the whole smart glasses narrative.
Exactly. A lot of firms view that as the next major hardware platform after the smartphone. Plus, they are seeing massive momentum with their underlying AI model, Muse Spark.
Okay, so the AI is actually gaining traction.
It is. And don't forget about Threads. They're boasting 400 million monthly active users on Threads now, which is a whole new surface area for ad revenue.
That's a huge user base. And what about the valuation argument? Because I know that gets brought up a lot with tech.
Right. So Meta's current PE ratio is fluctuating between 23.79 and 29.31.
Which sounds high for a company of that size.
It does, but analysts consider it attractive, even undervalued, relative to their growth projections. They are forecasting a 21% net income compound annual growth rate through 2026.
So the argument is basically that Meta will grow so fast that paying 29 times earnings today is actually a discount.
That's the bull thesis, exactly.
But wait, how reliable is a 21% profit growth forecast when they are literally pivoting their entire business model? They're moving from high-margin software to crazy capital-intensive hardware.
And that brings us directly to the bear case. Because the downside risk is entirely about margins and the sheer cost of this pivot.
Right. Tell us about the CapEx projections, because this is where things get scary.
The sources outline an unfathomable capital expenditure projection for 2026. Meta is expected to spend between $115 billion and $135 billion on CapEx.
Up to $135 billion in a single year.
Yes. And that threatens to severely squeeze that beautiful 30% profit margin we talked about earlier.
I mean, how could it not? And we're actually seeing the human cost of this right now, aren't we?
We are. The breaking news just came out that Meta announced a massive wave of layoffs. They are cutting 10% of their global workforce starting in May 2026.
So what does this all mean? Think about this. They are firing 10% of their human workforce just to pay for more servers.
It's a massive reallocation of resources.
It's crazy. They are feeding the AI beast at the direct expense of their human capital. Does this desperation to lead in AI validate the bears here?
It certainly gives them a lot of ammunition, especially when you look at the macro charts. The bears are pointing to a terrifying head and shoulders pattern that is currently forming on the weekly charts.
And for anyone who doesn't follow technicals, a head and shoulders pattern on a weekly chart is a massive red flag for a long-term trend reversal, right?
It's one of the most reliable bearish signals out there. If the right shoulder completes, the whole macro trend shifts from bullish to bearish.
Wow. Okay, so we've laid out the fundamental tension between the record earnings and the massive spending, and we've looked at the chart battlefield. Let's synthesize this. Give us the short-term versus long-term outlook. What is the absolute best-case scenario here?
The best case scenario is that Meta breaks cleanly above that $681 resistance and then clears the next psychological level at $706.
So a structural breakout.
Exactly. If they do that, the momentum from the AI catalysts, the glasses, Muse Spark Threads, could easily push the stock toward that $840 median analyst target.
And the market would essentially be saying, we believe the May layoffs will protect the profit margin despite all the server costs.
Yes, they'd be buying into management's vision entirely.
Okay, but what is the worst-case continuation?
The worst case is that the massive 2026 CapEx projections just completely spook the market. If institutions dump shares because they fear the free cash flow is gone and that head and shoulders pattern fully executes,
And how far down could it go?
the chart suggests a brutal potential retrace all the way down to $437.
437 from almost 700 today? That is an absolutely catastrophic loss of shareholder value.
It would be a total repricing of the company. It would mean the market is no longer treating them as a dominant ad monopoly, but as an over-leveraged hardware company.
Which brings us to the most immediate catalyst on the horizon. Because we don't have to wait long to see which way this breaks.
Not at all.
The sources confirm that Meta is scheduled to report its Q1 2026 earnings in just 9 days, on April 29, 2026.
That date is going to be the match that ignites either the bull or the bear scenario.
100%. So I want to leave you guys with a final provocative thought based on everything we've looked at today. When those earnings drop next week, what should you really be looking for?
It's not just going to be about the top-line revenue.
Exactly. Will the incredible profitability of the family of apps continue to mask the relentless cash burn of Reality Labs and this massive new AI server farm? Or, and this is the scary part, is the golden goose finally getting too expensive to feed?
That is the multi-billion-dollar question.
It really is. Well, we want to thank you guys for joining us on this deep dive. Keep asking the hard questions, keep digging into the data for yourselves, and we'll catch you on the next one.